The U.S. banking sector is facing a wave of concerns as the largest banks in the country release their third quarter results. What was initially expected to be a routine reporting period has raised alarming red flags, indicating that the situation may be far worse than previously anticipated. As Wells Fargo, Bank of America, and J.P. Morgan Chase unveil their financial performance, it is becoming evident that the sector is grappling with significant challenges. From mounting charge-offs to increasing delinquency rates and potential impacts on lending standards, the implications of these developments extend beyond the banking industry and could have far-reaching consequences for the overall economy. In recent days, these major banks have collectively reported approximately $5.3 billion in charge-offs on delinquent loans. This figure represents a substantial increase in non-performing assets and suggests that the impact of bad loans is more severe than initially estimated. While this amount is considered a conservative estimate, experts believe that the actual figure could be significantly higher. What is particularly concerning is that the problem extends beyond the major banks. Smaller banks across the country are also grappling with similar issues and are being forced to write off substantial portions of their loan portfolios. The practice of carrying losses on their books for an extended period and only addressing them now raises questions about transparency and accountability within the banking industry. To mitigate the potential shock to investors and shareholders, banks have strategically chosen to report these losses in the third quarter. Writing off billions of dollars in uncollectible loans within a short time frame could potentially harm market confidence. By staggering the impact over multiple reporting periods, banks aim to avoid sudden disruptions while still addressing the underlying issues. The $5.3 billion charge-off figure is not only the highest since mid-2020 when the pandemic was at its peak, but also nearly double the amount recorded during the same period last year. This surge in charge-offs reflects the growing delinquency rates, which have been steadily rising in recent times. Economists at Bloomberg expect this trend to continue, predicting that charge-offs will increase further in the coming quarters. Another challenge facing the banking sector stems from the commercial real estate market. Vacancy rates in office buildings have surged due to flexible work arrangements and remote work becoming the new norm. Landlords are experiencing significant cash flow declines, leading to potential declines in valuations and the value of commercial real estate loans. This domino effect poses a considerable risk to small and mid-sized banks, potentially pushing them into insolvency next year. Furthermore, stringent regulations imposed on banks require them to maintain liquid cash reserves to cover anticipated losses within a specific time frame. With economic conditions becoming more uncertain and volatile, regulators may demand an increase in reserves. This not only makes it harder for individuals and businesses to secure loans, but also leads to more stringent lending standards. The erosion of trust in the banking system is another critical issue. Recent data from Bank of America reveals that consumer funds have seen the largest outflows since February 2014. This suggests a decline in confidence among individuals, further impacting banks' stability and liquidity. As third-quarter results from major U.S. banks reveal troubling signs, it is crucial for stakeholders to closely monitor the situation. The implications of these developments extend beyond financial institutions, potentially affecting lending availability, interest rates, and overall economic stability. As uncertainty looms over the sector, it remains to be seen how banks will navigate these challenges and what measures will be taken to restore stability and regain trust. The future of the U.S. banking sector hinges on strategic decision-making, regulatory actions, and economic recovery efforts in the months ahead. Please like and subscribe if you want to learn more.